All right, hello and welcome back. This is the fourth mini lecture in this risk lecture series. So I have four lectures that I have four little mini lectures that go together. All right, in lecture one, I really tried to set up this idea of risk and uncertainty, separate the two, identify that we humans don't like uncertainty and ambiguity. And as a consequence, we shy away from it. It makes us feel vulnerable, can make us feel vulnerable. It gives us kind of a feeling of not knowing, which can create some level of anxiety or discomfort. We tend to try to avoid it as a consequence. Risk is a subset of the uncertainty. Elroy Dimson said risk means more things that can happen than will. I do think that that's true if you think about it, that within the range of possible bad outcomes, more things can happen than will. I agree with that. But it's really uncertainty that sets up this idea that more things can happen than will happen. We also talked in that first lecture kind of how people think about uncertainty versus control, and those play an important role together, leaning on the work by Atwater in his book, The Confidence Gap. That's kind of a nice construct. And then we started to move into this idea of investment risk. And you really need three elements for it to be investment risk. Number one is uncertainty. Without uncertainty, there's no risk. Number two is a commitment of capital. That's what sets you up for the potential loss. And then the last one is a potential loss, obviously. We then layered in the Italian cookie, which I thought was really important. You can relate back to, is the risk really being caused by too high expectations for growth, or is it the durability of the competitive advantage, the sustainability of those excess returns? All right, that's important. We then introduced these kind of 3D charts so you could see that uncertainty tends to increase as the time horizon increases. And almost by definition, the amount of risk will increase with that increase in uncertainty. Only, kind of that tail risk, the risk that's to the left of the price paid for the investment. If you're not paying for growth in that case, like Buffett when he invested in Apple, then you really aren't exposed to a lot of business valuation risk, growth risk, although you may be exposed to sort of competitive advantage risk. That's kind of the things. And then I kind of showed all of that. All right, now we're going to shift gears and we're going to talk about volatility, risk management, and I already did talk about the risk relationship between risk and research. We already did that at the end of last lecture. Sorry about that. All right, so let's talk about volatility. I think, this is kind of my observation, one of the key challenges in fundamental investing, value investing, fundamental investing, long duration investing is developing or having a strategy to deal with or respond to short-term volatility. I think this is one of the pillars of long-duration investing is what are you going to do with drawdowns? What are you going to do with that negative volatility? Upside volatility tends not to be a problem. But I think this is one of the challenges going in. If you're going to try to hold these positions over time, you've got to have a strategy to be able to deal with volatility in price volatility. Now, the strategy may need to be structural. With a serious attention to the emotional challenges of dealing with volatility, particularly negative volatility. If you think about Buffett, when he converted to Berkshire Hathaway, he had permanent capital, so he's structurally able to deal with vol. Howard Marks is structurally set up to deal with vol. Ackman, one of the main reasons that Ackman's trying to get permanent capital so he can deal with short-term vol. So these brilliant investors, it's not lost on them that they have to be structurally set up to be able to deal with volatility. And this is a great quote from Howard Marks. I have a couple of them from Marks. He's written a lot about risk. He said, look, you've got to be able to position yourself to have the ability to hold on and come out the other side. That's how you deal with volatility. All right, we talked a little bit about rational beliefs earlier in the lecture series, but this is, I think, a fairly new area for me, this idea of rational beliefs. But it's rational beliefs that can generate volatility because the true economic model is unknown by every investor. No one knows exactly what the economic model is. You have multiple rational long horizon beliefs. They can and do exist. That's the key. They can be quite different. Rational in that they're consistent with the fact, quite different because people have a different sense of what's going to happen in the future. And then shifts between those different belief causes valuation adjustments, especially for long duration assets, and that's volatility. So you can have quite rational behavior and still have volatility. So volatility is not irrational. It's the natural outcome of rational uncertainty about the long run. So it is part of it. I don't subscribe to the idea that volatility is only driven by irrational investors. In fact, I would argue it's primarily driven by differences of opinion. And as time rolls on and new information or new analytics come into the market, people change their estimate of value. It's pretty simple. And I think that I really believe agents are rational, but because the true economic model is unknown, no one knows what it is, multiple statistically coherent beliefs can exist. Statistically in the sense of analytically robust. Shifts between them generate volatility. It's not that confusing. So I don't really subscribe to this idea that it's irrational or only external shocks. It arises from rational shifts in long-term, long-horizon beliefs. That makes sense, right? All right, we did set this up that risk is the possibility of loss or injury, harm, and you try to avoid it or at least get paid for it. So does volatility equal risk? Now, the part that's fascinating to me is if you go talk to people on Wall Street, they will tell you that volatility is equal to risk. And I want to tighten that up or at least respond to that. If you go talk to kind of the Buffettologists, the Buffett world, the long duration, they said volatility is not risk. And Buffett and Munger were pretty adamant that volatility is not risk. Now, I don't think it's a binary. I don't think it's volatility is risk or isn't risk. I'm a big believer the question should be slightly different. When does volatility equal risk? It's not, oh, it's always risk or it's never risk. It's when does volatility equal risk? And for me, it really comes down to the following. Does the price change reflect evidence of new information, noise or signal, that will impact your estimate of intrinsic value? So if the price change does reflect new information, then that's clearly important. That's really important. That is back to that rational belief. People are acting on information or new analytics quite rational, so I don't have a problem, right? So this is the observation, and this becomes important when you go talk to people in academia. The more informationally efficient the stock price is, that means really in our world, price equals value, then the more volatility represents risk. Because the more the stock price is informationally efficient, the more the stock price is close to the true value, to the true value, then the more that volatility represents risk, because that's really represents the change in intrinsic value. People are responding to information. They're responding to some new analytic or something like that. And therefore, because it's informationally efficient and close to P equals V, and guess what? Vol and risk, I think, are pretty closely tied together. Now, what's important to keep in mind is uncertainty relates to the estimate of intrinsic value. That's what we talk about. Volatility relates to price. So uncertainty relates to estimate of intrinsic value. Volatility relates to price. All right, so when P does not equal V, which is what we're always looking for, I guess, in the fundamental world, then volatility does not equal risk. When price is less than or does not equal intrinsic value, then volatility, vol, remember, relates to price. Uncertainty relates to value. Therefore, if we have an informationally inefficient stock, then guess what? Vol is not equal to risk. So in those situations, the greater the conviction you have in your estimate of intrinsic value, the more confidence you have in holding the position. So we're back to Marx and Buffett and related. I want to say this one more time. The greater the conviction you have in your estimate of intrinsic value, the more confident you can hold your position through that vol. And that, to me, is the insight. Now, if P equals V, guess what? All price changes will be driven by new information. And now that uncertainty and vol have very similar pattern. They're going to be on top of each other. Now I would argue that in that case, vol is closer to risk, which is important. So it's approximate of risk. So now we have I think a nice setup between risk and volatility. The more you believe the market is efficient, the more volatility is going to be a good representation of risk. And in the academic world, the true believers, the FAMAs of the world, believe the market's pretty informationally efficient. They're willing to believe that vol and risk are highly related. Lots of academic studies about all kinds of anomalies, that aside. The practitioner world, I think people that don't believe that price and value are that tied together almost by definition. Therefore, I think that's one of the reasons they're not willing to accept this idea that vol is risk. So that's the key. All right, so here's our setup. Market implied value growth is 3%. Target is 7.5%. I've added the Italian cookie, which is important. Remember, volatility relates to price. So that volatility is going to be driven by, in this example, be driven by changes in estimates of growth. You can see that volatility. But if you have a high degree of confidence in your target price, you can live through that volatility. I think that's what's really important. All right, volatility related to valuation, earnings per value, is going to be really related to the durability of the competitive advantage. So you have two real fundamental sources of volatility in stocks. One is that volatility, difference of opinion related to growth. That's that market implied value growth. And you have volatility in valuation, which is really competitive advantage. So we're back to that construct, which I think is really important. Is this valuation risk or business risk? James Montier says, right, valuation risk or business risk. Valuation risk is really related to estimates of growth, whereas business risk is in estimates of the durability, confidence in the durability, sustainability of that competitive advantage. But that's price, right? That's related to price. If you have a high degree of confidence that in your target growth rate in this example, then vol is potentially an opportunity, which we'll talk about. All right. Now, the seduction of vol as a measure of risk is it's easy to measure, at least historical vol. So that's got something. And I think I've been teasing at this for a couple of slides, but ironically, if volatility is assumed to equal risk, which most hedge funds seem to believe, I hear that from hedge funds all the time, that vol and risk, then P equals V. By definition, market is relatively information efficient, which most hedge funds do not believe. So you can't have it both ways. You can't say vol is risk and, oh, by the way, price and value are different. It doesn't work. So we need to tighten that up, and I'll show you in a minute. And what it really is time frame. All right, Sharpe ratio. I'm not going to go into a lot of detail, but Bill Sharpe got the 2000 Nobel Prize in Economics for his work on CAPM, and this comes out of that. And this kind of measures the return against the volatility of the portfolio. Simple way of thinking about it. Very volatile portfolio. You can have random events that look like you have great performance. So if you have great performance, but the underlying assets are highly volatile, we don't know whether that's luck or skill. If you have great returns and a very low volatility performance, the idea is, well, that's skill because you've eked out that alpha in a low vol portfolio. All right. However, it calculates both upside and downside vol, which is the case. So, and it's used to calculate risk-adjusted relative returns, assuming, of course, volatility is your measure of risk. Right? Second ratio called the Sortino, which is essentially exactly the same thing, but we take out the positive volatility because we like positive volatility. When stocks go up, we like it. I guess if you're short, not the case, but if you're long, you like it. So this is the same thing as the Sharpe ratio, but get rid of all the positive volatility. All right. Now, there is a different psychological impact, and we've really got to go back to Kahneman and Tversky. In their case, this prospect theory, which I always get the year wrong. I think 1967, but somebody on the tape will correct me. And what they've noticed, and this has been pretty well replicated, is the pain from loss is twice as intense as the pleasure from gain. Same thing, but I've now done it in the direction. I just wanted to show you the relative ratio and then to show you it in the direction. And more volatile stocks feel riskier because downside vol creates a more intense negative response. So more volatile stocks do feel riskier for what it's worth because of this prospect theory. Really important. All right, the other observation is that many investors look for a 2-to-1 reward risk ratio as a heuristic, which probably links back to this idea that the pain from loss is twice as intense as the gain. So I thought was kind of an interesting linkage. All right. So increased volatility, particularly increased downward vol, is often gets confused with higher risk. And I think it's really the psychological impact, which is important. All right. So now we get to the question, which really was the setup of this lecture, is under what condition does volatility have the potential to cause harm? And it ends up there four. Leverage at the portfolio and at the company level, redemptions, which we call impatient capital, fixed obligation, minimum required return, and self-imposed holding period, short-term performance-driven capital, and they're all time-based. So forced selling essentially this is forced selling at the wrong time, which constrains the ability to hold the position. We started the volatility lecture by saying the key is the ability to hold the position through the vol, particularly negative vol, both structurally and emotionally. And if you have constraints on your ability to hold that, guess what? You've removed that ability to hold through negative vol, and they're all time constrained, and we'll go through them quickly. All right, leverage. This is my favorite story. Is Bill Huang, Archegos Capital. He was levered, and he had a massive margin call that led for him blowing up. He took Nomura and Credit Suisse with him, and Morgan Stanley and UBS. Ironically, it's the Greek biblical word for leader or prince, but that was leverage. Leverage at the corporate level. Thoma Bravo, which is a big private equity firm based in Boston, they own this Medallia, and they had to hand over the keys to the creditors because guess what? It was highly levered, and the business model changed. Interest rates went up with the tightening of rates related to inflation. The business model started to change, and they handed over the keys to the private credit lenders. And guess what? It was one of the largest private equity losses in history. So leverage at the portfolio level or leverage at the company level can lead to not being able to hold a position through negative vol. That's the key. Redemptions is, certainly impatient capital. If your investors are not happy with your short-term performance, which you believe is just short-term negative vol, has nothing to do with value. But they can't tell the difference between negative vol, you're an idiot, you've lost money, or negative vol, we need to be patient. And so they're going to ask for their money back. We call that impatient capital, obviously, is the key. And so in the short run, it's very hard to tell the difference between negative volatility and a permanent capital. So they're not going to hold. They're not going to hold the position. Fixed obligations, a minimum required return, pension payouts, retirement benefits, or endowment. Well, you need a certain amount of cash flow every year. Guess what? You need that cash flow. And if you happen to hit a period where you have negative vol, a downward mark in your portfolio, drawdown, but at the wrong time and you're forced to sell, guess what? You're going to be selling. You're not going to hold that portfolio. And then I call this self-imposed holding periods, which is you're not gonna hold the position. And you see some of the pod shops are this way. They hold positions very short. If they have some negative downward vol, they kick out the position. So all of them are time constrained. You're essentially limiting your ability to hold a position through negative vol. That's when volatility becomes risk. So it's not does volatility equal risk? It's when does it become risk, and it's that structural constraint on your ability to hold the risk. It's that simple. And so for hedge funds, where they say that volatility is risk, it's because they have a very short leash on how long they'll hold positions when they're not working. They're not going to be patient. They're not patient capital that way, which is really important. All right, now this is a little generalized, but I just give you kind of a way of thinking about it. So hedge funds, pod shops today, they're incentivized to deliver short-term performance. Nothing wrong, not a comment, not a criticism. And they tend to have shorter holding periods. They're kind of trading oriented. My pod shop friends get mad when I say that, but they're driven by short-term changes in investor expectations based on incremental information. That's it. That's the game. And they're not going to hold through negative vol because their attitude is negative vol is equivalent with being wrong. So they're going to kick the position. Long-only funds have been historically incentivized to deliver long-term performance. And so they aim to have longer holding periods, sometimes very long holding periods. They're more, quote, investing oriented. And they're going to be driven by the company's fundamentals and long-term value creation. They're going to, in theory, hold through that negative. They're going to be more incentivized to hold through that negative vol. That's the key. Now, here's this. This is a chart that I stole from the internet. The idea of voting machines versus weighing machines. This really talks to Graham's observation that in the short run, the market is a voting machine, in the long run, a weighing machine. And so if you're holding short, that shorter time horizon, then risk and volatility are similar. I don't have any problem with that. But if you're willing to hold longer, then risk is really a function of margin of safety. The confidence you have in your estimate of intrinsic value, that's what's going to give you the confidence to hold the position, hold through that negative vol. But guess what? You got to be right. You certainly have to be right. And this is just another chart. So as the holding period extends to the right, then vol becomes less of a source of risk, and that margin of safety becomes a much better measure of risk. However, if your holding period is fairly short, I would argue vol is a pretty good measure of risk. So back to the question, when does vol become risk? It depends on your holding period, frankly, in my mind. That's the key. Now, fundamental versus speculative assets. We can talk about this. Fundamental value is this idea that the asset has a fundamental and intrinsic value, in my world, usually based on future cash flow. And then that fundamental value determines your investment strategy. When price is less than value, you should be buying. Price is greater than value, you should be selling. Speculative assets do not have a fundamental value by definition. That's how we define them as speculative assets. You're speculating solely on price change, which is a function of supply and demand. However, there's no systematic way to determine an investment strategy based on changes in price. So on the left, you have an investment strategy. On the right, it's hard. In speculative assets, they go up. Do you hold them because of momentum? Do you sell them because of price appreciation? If they go down, do you buy them because of price, some sense of value, or do you sell them because of negative momentum? That's the key. All right, so in fundamental assets, you can use volatility to your benefit. Right? If price gets below value, you should be interested. And a lot of fundamental investors say volatility is our friend. If, two things, very important, if you can hold the negative vol and you have a high degree of confidence in your estimate of intrinsic value. Two ifs, important. Speculative assets cannot use volatility to your benefit because it's based on price movement, not some fundamental value, some North Star, if you will. All right, Bitcoin, one of my favorite. A lot of vol in Bitcoin. Talking to a guy I know, very, very, very successful investor, very successful. And he asked me, I spent 5 years in the Bitcoin world, a long time ago, not a long time ago, but a couple of years ago. 5 years I'll never get back. And he said, I wish I had, I think he said, you know something about Bitcoin. And I laughed because that's the right way to say it. I know something about Bitcoin. That's about it. And he said, I wish I bought Bitcoin. I said, no, you don't. He goes, no, I wish I bought Bitcoin. I said, no, you don't. And he said, why do you say that? And I think he really means that, he said, how can you say that? And I think he really meant is, why do you believe that? But he said, how can you say that? And I said, all right, let's go through it. Humor me. What price did you pay? And he said, $1,000. So a long time ago, back in 17. I said, how much did you buy? He goes, $10,000 worth. I said, okay, great. All right, when Bitcoin went to 2,000, your investment went from 1,000 to 10,000. Let's see if we get this right. He bought 1,000 shares at $1,000. No, he bought $10,000 worth of Bitcoin. Doesn't matter. So your investment went from $10,000 to $20,000 in an asset you knew nothing about. You would have sold out the position, and then it went to 30, and then it went to 40, and then it went to 50, all the way up. And it would have driven you crazy. And he said, no, I would have held on. I said, all right, so it goes to $30,000, and then it goes back to $15,000. You would have been very upset with yourself. And he goes, no, I would have held on. I said, no, you wouldn't. That's the key. The vol. Nobody can live with this vol unless, right? Two things. They have a high degree of conviction in their estimate of intrinsic value. Well, guess what? Bitcoin has no intrinsic value. And two, they can hold the vol structurally and emotionally. And I would argue that not the case. So my final line is that highly speculative, very volatile assets, stay away from them. They're toxic relationships. Don't enter into it. He was not satisfied. All right, so Howard Marks said this, which I always thought this was a very impressive quote, and then I realized it's wrong. All right, so what he said, in fact, I never heard anyone say the prospective return isn't high enough to warrant bearing all that volatility. The point he's making is that if the prospective return is high enough, people will live with volatility. But the fact is, this statement's incorrect. Investors make this choice all the time. They don't like volatile stocks. They kick them out. So the prospective return isn't high enough to warrant bearing all. Investors do this all the time. He's wrong. He's wrong. Now, very sophisticated, long-term oriented, structurally positioned, maybe say that. Maybe he says that. Maybe people at Oaktree say that. But investors say this all the time, just for what it's worth. And then what he follows up, we can ride out volatility, but we can never get a chance to undo a permanent loss. But you've got to be positioned to be able to withstand the vol, particularly a negative vol, and have the confidence in your estimate of value. So Howard Marks, brilliant, brilliant, brilliant. I'm a huge fan. I've learned a lot from him. But in these two cases, he is really talking about a very specific set or type of investor. So the general investor, I disagree. All right, upside risk. I hear this all the time. I have talked over these 4 lectures that risk is harm, injury, harm, right? So what's upside risk? And the first time I really heard and thought about this, half a dozen years ago, I guess, or whatever, I was very confused and probably a little bit adamant that this made no sense. But I got thinking about it some more, and I thought I could come up with a way to explain it. All right. Upside risk is really an upside surprise that you're not positioned, the portfolio is not positioned well for. And it's the risk of missing out, so ROMO, which leads to underperformance. So it's sort of a portfolio level risk. So walk you through it. There's a positive surprise that one is not positioned for and results in underperformance. It's that portfolio performance risk. I put together a graphic that I hope helps. All right, so let's just index your position to 100, just to make life easy. Well, if the value of that portfolio ends up being less than you paid for it, the value ends up being realized less than you paid for it, that's permanent capital loss, and that's clearly risk. If you have a benchmark or some market and you outperform, we tend to call that alpha, you've outperformed. So the question is, what's in between what you paid for it and your benchmark? What's that? And that is that underperformance. And I would argue that's that upside risk. That's that ROMO upside risk, which is really important. And that's your upside risk. Underperforming the market, underperforming your benchmark, some business risk may be related to it. So if you outperform alpha, if you lose money, that's permanent capital loss. In between is really ROMO. That's that upside. So it's the risk of being wrong in your asset allocation, position sizing, or stock selection. And it leads to underperforming your benchmark. So that, I would argue, is upside risk. All right. Now, for individuals, I think it's interesting. I think rather than try to beat the S&P 500 some weird benchmark, I think what you should do is just beat inflation. Because if you beat inflation, you're getting rich over time. So I would argue that beating inflation, and this is a quote from a good friend of mine, he said, our goal is not to beat a benchmark in a given quarter or year, it's to expand the after-tax purchasing power of our partners over the long term. I think that's the right way to, if you're an individual. All right, let me talk about risk management. I'm not going into a lot of detail, but I want to touch on it a little bit. So there's 3 levels of risk management: the position level, the portfolio level, and the asset class level. All right, position level, if you're a long-term investor, long-duration investor, that's margin of safety. And this really is the conviction you have in your estimate of value. The bigger your margin of safety is, guess what? The bigger the lower your risk is, if you will. The more you can hold vol, the more you can hold on to the position. You got to be right, but that conviction. All right, that's the key. Now, margin of safety is defined as the gap between price and value. Price is often given for most people. Therefore, it's essentially a function of the estimate of value, your estimate of value, which needs to be a variant perspective. It has to be different than the market. And it's based on either an information or an analytical edge of some kind, or both. That's the key. That's your margin of safety. All right. At the portfolio level, it's position sizing, which is based on individual risk and the margin of safety. That's important insight. What a lot of people call risk management is volatility management. I really want to separate those two. And I guess that's the big value out of my risk management insights, is this idea of volatility management. And diversification, you're managing the correlation between assets. So diversification is volatility management, not risk management. Risk management is position sizing. Now, they're very closely related, because if I've got a bunch of positions I don't have a lot of confidence in, then I should have lots of small position, which was going to give me some level of diversification if there is low correlation between those positions. If there's a lot of correlations, just the same bet, different positions. So that's the key. So diversification is volatility management, not risk management. People always say, yeah, but volatility is risk. Okay, fine. You win. And you're effectively managing that mark-to-market, quote, losses. That's what you're trying to do. Now, if your job is dependent on volatility, or your risk to you professionally, it's a function of the volatility of your assets, then you want to do volatility management. God bless. All right, asset class. We don't have good risk management tools at the asset class. Hedging is very expensive and often ineffective. When I was running my small portfolio, we tried to do some of this. It's just, I was always on the wrong side of the hedge. It was expensive. It didn't really work. You had to keep, as the portfolio value went up, you had to check. Oh my God, it was very expensive. And it didn't work. So if you have a better asset class hedging, then go do that. But no one's ever explained one to me. And when I ran money for a decade, we never could figure one out. Cases. Now, I love Taleb, as I said earlier. And he said, when it comes to hedging, you either bleed to death with hedging, because that's what we found. You're giving away performance on something that doesn't really work, or you blow up with no risk management. So he always says those are your two choices. And so I kind of leave it with that. All right, that's the end of the deck. That's the end of the 4 lectures. I'm hoping this was helpful. Feedback is always appreciated. If you agree or disagree, let me know. That would be great. Thank you for listening.